And the title is Planning Implications with Large Loads. A lot of really interesting stuff going on with large loads, and we'll hear about a lot of it in the next hour and a half. And this panel is going to be chaired by Allison, the Director of Strategy for US East for the Pattern Energy Group. And Allison's been working in the energy industry for about 20 years and is working in this area in particular. So I'm going to turn it over to Holly and look forward to what the panelists have to say. So Holly.
All right, thank you, everybody. I think this is a great topic to end the technical workshop with. We've been talking a lot about supply, so it's very fitting that we'll end with large loads and demand. It feels like every single day there's a new announcement, at least in this country, for a 250 megawatt battery factory or a 250 megawatt or 1 gigawatt data center or Bitcoin mining in Texas or growth of electric vehicles. So just to add to all of our complications of retirements, coupled with bringing renewables on, coupled with our transmission challenges, we have a lot of large load that I don't think we have full appreciation for yet. But the good thing is we have some folks who have been spending a lot of time already planning for it and across different sectors. So the way we're going to run with this panel is to maybe start with a little bit of the more maybe predictable load, or at least maybe longer running load with electrification of transportation. And then we're going to go into industrial load, and then we're going to finish with maybe the most unpredictable place in our grid system for large loads in Texas with Lancium and ERCOT. So to kick us off, we're going to bring Cora and David from Edison to talk about integrating large EV charging stations, in particular for medium and heavy duty trucking. So, Cora.
Thank you, Allison. So good afternoon, all. My name is Cora Walter, and I'm a project manager on the e-mobility team at Con Edison. Our focus is really on the clean energy transition of the transportation sector. And next you'll hear from my colleague, David, who is on the engineering and planning side of our efforts. So today's presentation is really focused on giving early insights on what the electrification of the transportation sector will really look like, both at the distribution level, but perhaps also impact at the transmission level. So a little bit of an agenda for us today. We'll share a brief overview of the Con Ed system. We'll also speak a little bit more about electrification of medium and heavy duty within our territory, and some of the early analysis that we're doing in regards to that. And we'll talk more specifically about the impact of medium and heavy duty electrification in a specific dense area of the city, which is the Southeast Bronx area. So first, a little bit of an overview of our system. I know this is a relatively technical audience, so we'll not go into a lot of details, but I think what's worth mentioning is that we have a little bit of a mix on the distribution side, where at the transmission level, similar to what's been seen at other utilities, we have 500 kV, 345, 138 and 69 kV at the subtransmission level. And then when we transition to the distribution side, we have various primary distribution levels based on different boroughs, where we have 33 kV, 27, 13 or 4 kV. So our system on the distribution side is a combination of both your typical radial system with limited contingency. In addition to that, what is most of our territory is actually an underground network system with an N-2 contingency design. As you could see on the right side of the screen, our territory is New York City, as well as Westchester. We do have a sister utility, Orange and Rockland County, which is a little further up north, but we're really focused on the New York City area and Westchester. So next, we'll talk a little bit about what EV adoption is going to look like in our territory, but also understanding the driver for this transition. On the policy side, there's significant driver for EV adoption. As you can see, there's the Advanced Clean Car Act. There's really different policy that are going to drive adoption aggressively. And even looking at the chart on the right side, you could really see how EV adoption is predicted to certainly evolve far more aggressively than other technologies have done over decades. So really for us as a utility, while that is a great thing, we are also looking at this as there will be an inflection point, and we want to be ready before that inflection point to be able to keep up and not be challenged in supplying that load. So doing a little bit of drill down on our territory. So this is really the New York City area. And as you see some of the black not boxes, but some of the small shapes really are showing our networks. So on the network system, we are broken up in separate networks. And if you're looking on the screen, you'll see there's clearly multiple networks in our area, and the number of vehicles that we are looking at within our territory. So that's 80,000 medium heavy duty vehicles that are significantly clustered. And one particular, the photo that shows what a school bus lot looks like in the Bronx is really indicative of what we think is very specific to New York City, where medium and heavy duty bus depots are in highly dense areas, compact. I mean, just looking at this parking lot, vehicle parks like sardines, but ultimately is going to create significant electric growth and requires really a lot of expansion of the grid. So as we mentioned before, certainly a lot of policy goals driving electrification of different type of vehicles, whether it's school buses, city buses, and quite honestly for us, even as a utility, as we have a significant fleet as well. So next, I wanted to walk people through what our methodology has been thus far in even assessing what the impact is going to be to our area. One of the very first thing that we've done is really to look at our entire service territory. And we wanted to do so in the context of looking at specific filters. So whether it's industrial business zones, disadvantaged communities, key factors that would provide us visibility on where medium and heavy duty is going to be, where there's going to be significant public charging of light duty fleets as well. So zoning was really the first layer of study for us, where we specifically looked at industrial business zones, the disadvantaged community, commercial zones. And one thing for us in our territory, these are really primarily in the outskirts of the boroughs, which also coincides with areas of constraints on the grid. The next layer of filter is looking at really infrastructure needs. So when we're thinking about public charging or where light duty vehicles are going to charge, it's really critical to look at where airports are, where trains are, as we think it's going to drive significant traffic within those areas. Another layer of review is really looking at vehicle routes. So that's something that's really critical to fleet operators today. How far the vehicles are traveling, where are they stopping, to understand really, will these vehicles charge within the depot, Will they charge en route, or are they expected to charge at their destination? Really critical information for us to understand where we need to build this infrastructure. And really the next thing is understanding, so as we go later into this presentation, you'll see a lot of mentions of hotspots. And what we are defining as a hotspot is really an area of high density of medium and heavy duty vehicle compounded with grid constraints to meet that need. So we really had an opportunity to look at all the hotspots within our territories and understand how to best evaluate them, whether there are needs today or perhaps needs that align for full electrification scenarios towards 2040. And last but not least was really a diversification factor in taking the next step of our study. So we found actually quite a few number of hotspots within our territory, probably about 20 hotspots. And in really taking the steps to do much more detailed analysis, we wanted to think of different criteria on how we picked the different hotspots, those that had very similar criteria. Perhaps we really looked at things that were either network areas on the radio system, areas that are predominantly industrial versus residential neighborhood. So these were some of the criteria that we use to further define which hotspot we will focus on. So next, I'm gonna turn it over to Dave, who will walk you through what our engineering methodology has been to think of how the EV load is going to impact us at various levels of the grid, as long as like a specific case in the Southeast Bronx.
Thanks, Cora. So my name is David Sohmers. I'm Cora's colleague. I'm a section manager in engineering planning in Con Edison, and I'm going to talk to you today about the methodology we used to do this proactive study. Before diving straight into it, I just want to elaborate on why we thought this was important to do. The current utility process for interconnections for new customers is such that we wait for the customer to initiate the request. So for an electric fleet looking to electrify, what that would look like is that would mean they would have to hire an electrician, an engineer, an architect, or developer to apply for service, meaning they have to have a site plan, they have to have a load letter submitted to us, and then we would start with the engineering process. But as Cora has mentioned before, this inflection point, we know this S-curve is coming, and we as the utility do not want to be the bottleneck for preventing electrification from being possible for these fleets. So in this approach, we took a proactive method to try to estimate and find where these fleets are going to be, what that would look like, and how to build our distribution system so that once they're ready to electrify, we are ready to connect them. So the first step we took is finding where are all the vehicles located in the city. As Cora showed before, a map of all densities of the fleets. We also did additional studies and verification. So we looked at publicly available registration data. We did geospatial reviews on our own. That's basically manually looking at maps, aerial views, checking out to see how many vehicles fit in these lots, how many do we see in Google Maps, et cetera. And then we estimated the fleet size by location, and then we separated them out by the weight class. And we know that there's studies being done as to what battery size those type of vehicles would need in order to electrify. We also looked at, based on policy goals, what type of electrification ramping would need to occur when. So when vehicle sales for certain vehicles would need to transition, we use that for our analysis to see when our distribution system would start becoming overloaded. We also created a methodology to find out what that energy consumption would be based on the load profiles. And we would aggregate all that information and figure out the demands that would have on our system. So what we wanted to do is we took as part of the pilot study, we took one example in one network, and we said, if we were going to electrify this area, this dense fleet area, what would that look like? So for this study, we picked out the Southeast Bronx. So this is just an aerial view of what the network looks like for the Southeast Bronx. The green boundary here is what the network is carved out as. And the fleet concentration that we identify using this methodology is in the magenta shaded region. This is accounts for over 20% of the electric of school buses that service New York City. When we carved out this area, we created a map to spot the loads of where these fleets are located. So the different colors indicate the different type of fleet. The green color is sanitation, the blue is MTA, and then so forth. We have school buses in yellow. After doing that, you can see on the right-hand side, a zoomed-in image, you can actually see how tightly packed the school buses are. And we use the methodology I explained a few slides ago to estimate what we thought the load demand would be for each of those sites. And then we aggregated them on the system. So once we applied all the loads and we did our analysis, we basically ramped it through the years with electrification. And the left-hand graph here you have here is the feeder loading by year. So these are the distribution feeders that Cora mentioned. In this case, it was 13 kV distribution feeders. There's about 30 feeders in the network. The blue bar is the number of feeders that are currently not overloaded, and the orange bars are the feeders that would overload as electrification ramps up. And you can see by the year 2040, a majority of our feeders are overloaded. On the right-hand side of the screen is the area station capacity that feeds this network. The shaded gray region is the current forecasted load, baseline forecast through the year 2040 without the electrification that we identified in this study. The blue shaded region is the ramping of the electrification for this spotted load. And you can see that it advances the need for area station relief by 10 years. So by the year 2029, we would need to initiate area station relief in order to be able to support the electrification of these fleets. This here is a map. So what we did here is we said, okay, if we need to prepare on the distribution side a solution for how to electrify, we know the feeder is going to overload. How would we be able to supply those loads, the final loads? So each of the colored lines in this graph on the right is a feeder band. So a feeder band for our system is 2 distribution feeders, in this case, 13 kV feeders. In total, this accounts for over 12 miles of feeder extensions. To do those extensions, we would need 166 structures, 326 cable sections, and also do area station relief, like I mentioned in the previous slide. The black lines in this graph, that's the current distribution system. So in this solution, what we're looking at doing is providing nearly dedicated feeders all the way from the substation to this load pocket that we identified where we would need to distribute the load. And just to give you an idea of what this looks like, on the right is an aerial shot showing how dense and how much is involved with having to dig and the amount of disruption and permitting that we would need to do in order to provide a distribution solution to this customer. So this is the final slide. Some takeaways. This was a pilot study. It was just to give us some insight as to what it's going to take to facilitate a distribution solution for all these large loads. And it comes down to planning and policy. On the planning side, one of the key takeaways that we had is that a lot of these high, medium, and heavy duty vehicles are going to be in industrial and commercial areas. In this case, it was in the fringe areas, so we have to do significant extensions of feeders in order to facilitate the rapid increase in loads. This is going to have other implications that we need to be better prepared for. We need to make sure we have resources. We need to make sure we have equipment to be able to install what's needed on the distribution system. Cable forecasting needs to be modified, and et cetera. On the policy side, we have very ambitious clean energy transportation goals. It means that our distribution system and transmission system need to grow in advance. We can't wait for customers to initiate requests to us. The utility and the distribution industry has to be proactive, and that was really the main goal of this project. With that, I will hand it over.
Thank you, Cora and David. I was reading a research paper that National Grid did with Hitachi, and they were basically saying that you could see 50 megawatt loads for medium and heavy duty truck centers. So like industrial sized loads in the winter are going to be required every time you have a truck center. So anyways, from industrial size loads to industrial size loads, Michael Walsh with RedoxBlox is going to talk to us about industrial heat electrification.
Thank you. And thank you, Charlie and ESIG, for putting this topic on the agenda. I know I spent most of my career in the grid and renewables area so far, and started dipping my toe into industrial heat about earlier this year. And it almost feels in some ways like when I started dipping into renewables and wind first. And I think with some of the slides and some of the work that Con Ed just illustrated, that you'll maybe begin to see why. I just pulled out some numbers that I think we all know them. There's nothing here that's new or surprising, but when you start to think, well, wait, what does this really mean? What will it mean for us in the grid? It's incredibly exciting. And I think ESIG continues to be at the forefront of technical leadership in our industry by bringing this topic on. I think we'll come back here in 2 or 3 days and we'll be the plenary open, not the plenary closing. But let's see. So I suppose my messages, and a lot of these were touched on in the previous conversation. This is big. This isn't something that's a small adjustment or an incremental improvement or an incremental change to our system. This is going to be between 2x and 3x of our industry. An industry that's taken us 100 and something years to get to this stage is going to do something between doubling and trebling in the next 28 years. And we're going to just talk through some of the impacts. What does that actually mean for us, and what's the practicalities of it? And I think at a level we all know it, but when we think about it, we sort of ignore and we don't fully think it through. I loved your slide on the adoption rates. This is going to happen suddenly. This isn't something that's going to be driven by a utility scale process or an interconnection queue or waiting for, large multi-billion projects to be financed. This is going to be driven by end users, and they adopt technology in a completely different way to the way we roll out technology in utility scale systems. Some of the messages I'll touch on. There's good and bad in this. If you want to just take purely a system operator, power grid engineer point of view, it's going to make some things much, much harder for us and some things much easier. And we need to think strategically about what they are. And if we think about them and take advantage of the headwinds, send good signals early, it's going to make things a lot easier. This doesn't fit into our current systems. We designed systems originally around markets to deal with, large spot loads and demand that was purely reactive. That's not the world of the future. We're going to, in a net zero world, have zero marginal price generation and highly responsive demands. And we're going to have a completely different way of using our networks. So when we take all that together, maybe I'll throw out some ideas about what I think we should do differently. But, I see it really as the start of a conversation rather than something that there's a lot of research questions. I think, Allison, you were asking, what is there to research? I think there's a lifetime of PhDs in this. So one day it's big. National Grid, ESO published their future energy scenarios every year. And the graph on the left is the energy demand as it is today. So I know you can't read it, but there's a link there. The piece in the middle is total electricity energy at the moment. It's about 317 terawatt hours a year. The two graphs on the right are the two extreme scenarios, one being on the top, most ambitious, most progress made towards net zero. And that shows a trebling of electricity demand by 2050. Interestingly, the one at the bottom is the most pessimistic scenario. So that's the one where we make least progress, things move slowly, and we don't get quite where we'd like to be towards net zero. And in that scenario, electricity demand doubles. You'll see very similar numbers in Bloomberg New Energy Finance, in World Energy Outlook, in demand forecasts for TSOs over the world. But when you actually think about what that means in terms of your network, your grid, your transports, all your policies, everything, It's very, very fundamental. This is very similar to the graph you showed about just the pace of evolution. And like the piece on it is, it's driven by user adoption. It's driven by end user adoption rather than by, a utility process or an interconnection queue. And that is a lot of things. Like if you start going and telling a school district, for example, they can't electrify their buses, that's much more potent than telling a renewable developer they can't connect a wind farm. It's a different dynamic in the society and in communities. And a lot of it is going to be stuff you don't see coming and can't fix. I'll just touch briefly on the technology side of it. And the key takeaway is it's coming very, very quickly. When I was looking through some numbers for this, I was, Googling, and it reminded me, like last time I did one of these, if you found a stat or a paper that was maybe 2-3 years old, you'd take a number out of it and use it. In this sector, anything more than a year old in hydrogen, in thermochemical storage, in electrification of demand, it's pretty out of date very quickly. This technology is racing at a really, really fast speed. The RedoxBlox technology is for high temperature industrial heat. So it's essentially decarbonizing anything where you currently use natural gas. It takes electricity in as an input. It drives it through a redox reaction to essentially deliver it and to store it in a chemical bond. It has very high energy density, about the same as lithium ion, so can fit in very compact spaces, and it can then throw it out as 24/7 heat. So from an electrical point of view, from a grid point of view, the core application is you can consume the electricity when there's a lot of renewables available. So maybe 2-3 hours a day, you soak up surplus renewables, you store it, and then you give it out as 24/7 heat at high temperatures. And you can use that in the hard to decarbonize sectors like cement, steel, etc. And we have a number of competitors in this area. We're moving very quickly with our technology. We're moving into first industrial deployments next year, but we see ourselves deploying in the gigawatt hour scale within about 5 years. It's a much easier technology to scale up than things like wind turbines, etc. You don't have to break new engineering challenges every step along the way. You just pack more of the same material into a larger box. And there's similar competitors out there doing thermal storage. Hydrogen is a very similar use case, and all of these technologies are moving quickly. So obviously I think our one will be the winner and dominate, but even if it's not, there's plenty of others that are on a similar trajectory and moving with a similar speed. And what that means, sorry, I went the wrong way. What that means is just, if you look at some of the volumes, this is the numbers from Ireland. Again, they're very similar. So Ireland at the moment has about, give or take, I think 39 terawatt hours of electricity demand per year. Our industrial heat demand that's supplied by fossil fuels is 13 terawatt hours or 15 terawatt hours a year, sorry. So if you just think about it, like Ireland has got a strategy towards decarbonizing and electrifying our industrial heat. So whether it's RedoxBlox, hydrogen, thermal storage, something different, the pathway is towards electrification. And that's going to add about 1/3 of the electricity demand to the system when it happens. And that could happen as quickly as within 10 years. So you add that onto your EV projections, your transport projections, your domestic heat pumps, you start to see the picture. Interestingly, it's very close to the amount of surplus renewables that we expect to see on the Irish system. So we see about, I think, 13 terawatt hours of surplus renewables forecast by ERCOT in 2030 on the Irish grid. And there's about 15 terawatt hours of industrial heat. So one of the things we need to think about is how can we make better use of the resources that are available? There is a nice marriage in this, but it's not going to naturally happen. It's going to move very quickly. So your point about needing to plan and be ahead of this and think it through, that's exactly right. And exactly the same principle applies on industrial heat. And I think we need to prepare ourselves for the speed at which these things will happen. This is just an example of what it means on one site, just to maybe help get an appreciation of it. So this is essentially, I'll start at the graph at the bottom. This is an industrial site that we're looking at in Ireland. And we're looking at it because they're contracted in a way where the sort of dark gray graph at the bottom is their typical weekly energy consumption. The red line at the top is their maximum import capacity. So this site has signed up a lot more grid capacity than they're actually using at the moment. So they're very good for us as a demo site because they have spare space where you can actually demonstrate it. So we're doing a project to electrify 10% of their on-site heat demand at the moment. And the purple graph on top of it is the additional electricity consumption. And this is coming in at times where there's curtailment on the grid in Ireland. So in this demo project, we're only going to use wind that would otherwise have been curtailed because of too much wind. So you see it's sort of bunched into the hours where there's too much wind. You could obviously imagine all sorts of different profiles and different things the system operator could do with this to flatten out demand curves. But what's interesting is this is just 10% of their on-site demand. You multiply that purple curve by 10, and you start to see very quickly what that's doing to one industry site. What's that doing for the local grid around the area? What's it doing for power quality, for demand balancing, for network planning? And interesting what it's going to do for their bill. So even though they're consuming electricity that's notionally zero price electricity, their actual charge for it will be significant because they would need to increase their connection agreement and pay much more network charges. And it means the whole economics of the solution from the industrial customer under the current network charging rules just would not work. Just some observations, and these maybe fit into, I suppose I'm going to bring out just 4 observations and then talk about, well, what do we do with this in terms of what are the takeaways and things we should work on. And the first one is, look, industrial gas is way cheaper than industrial electricity. Like, one of the challenges we have, it's not that we can't find good technical solutions to electrify it, it's even if we come up with a perfect engineering solution that's 100% efficient and zero capital cost, a kilowatt hour of gas at an industrial premises is between half and 1/3 the price of a kilowatt hour of electricity. In Europe, when you add on a carbon price on top of it, you maybe get to around half the cost. But there's a huge delta there. And if, as policymakers, we're serious, or policymakers are serious about moving to net zero, that's a fundamental barrier that is hard to see how we get around it. We can look at sort of solutions like, how do we take the advantage of the curtailed renewables? And that's what we're doing in the demo project in Ireland. There's a quirky market structure where you can essentially procure that at zero cost. But that's not scalable. That's not scalable into terawatt hours of scale. You can do very significant, when you do electrification of industrial heat, you can deliver very significant grid services. Most of the technologies in heat are fairly unfussy. You can turn them off instantaneously, you can ramp them up, you can ramp them down, you can schedule them in advance, you can change the schedule. They're almost, fully configurable loads. And when you couple that with, the need to make use of network, like how are we going to get these through a network? It is going to add up in terms to a much flattening. I think the duck curve or the canyon curve in CAISO, if you electrified all the terminal and you were trying to get it through existing networks, it would naturally lead you to a much flatter demand curve than you've probably ever seen before, with huge amounts of very fast acting reserves available. So there's a lot of positives if the incentives are there to put in the control systems and design them right. It adds really, I don't know, maybe less than 1% of the capital cost of a project to set it up so that it can deliver these services and be highly responsive. On the grids and tariffs piece, I think, I'd extend maybe the point you made about the distribution planning to transmission. And I think we have to think big in this. I'm just using Ireland as an example. I think you'll see similar dynamics in most places that are building offshore wind that have coastal economies. The graph on the right is the location. All the green bubbles are where we expect new offshore wind facilities to connect. And we're talking, 5 gigawatts offshore wind in the next maybe 8 years. We're talking maybe another 3 or 4 onshore wind connecting. And the map on the right is a map of heat use in Ireland. And you can see the various red dots around the major cities are all quite close to the coasts. These are the areas that are the biggest consumers of heat at the moment. And these are very close in some ways to renewables. So what we think is very helpful is, if you're going to be building new connection assets for the offshore wind, you need to co-optimize this with where the industrial heat is. And I'd encourage anyone that's looking at a transmission plan, if you believe that there is going to be electrification of heat, there's good heat maps available in most countries. You can see where gas consumption is very high at the moment. And then you can say, okay, well, how am I going to look at meeting that demand? Because credibly, we're not going to be able to double our grid infrastructure. It's almost impossible to build new grid assets. And we can add little lines here and there. We can do some big lines, but there's no credible way where we're going to be able to double the infrastructure. We're going to need to use every efficient technology to maximize the existing grid, but we're also going to be really, really smart about co-optimizing our plans of where we're adding new generation resources with where our new demands are going to come from. We're also going to have to look at the network tariffs. When you look at this in an industrial tariff side of view, and you start to do really radical things and want to respond in real time and add overall efficiency to the system, it's almost intractable. You know, most of demand customers, when you look at their tariffs, you get a 60-page document that has all these exceptions and rules and rules and rules and rules. And if you do something that's slightly out of the ordinary, not envisaged, it's almost impossible to model exactly what that'll be, except you can guess it'll be bad. And these things just, they all speak different languages. You know, they speak, you know, triad network charging, where you get charged on your third highest peak in a 12-month period, and that sticks with you for 2 years. You get these types of constructs in all these charges. You also get a lot of, you know, renewable subsidies that are passed on a flat per kilowatt hour basis. And at one level, that makes sense until you start trying to buy really cheap off-peak electricity and make it cheaper than gas. What you can actually find is just the cost of subsidizing the renewables that's added on a kilowatt hour basis gets you up close to the cost of gas on its own. So there needs to be more thought in what signal you actually want to send, what's the overall economic right answer. So I suppose, you know, some priorities. I think, you know, you talked about the way you overlaid maps and you showed the geography of it. I think we need to move to really meaningful whole system paneling. And in that, I mean, realistic looking at what the geography on the ground is, where people live, where are the thermal loads, where can you build new generation, where it's coming in. Some of the work in the UK at the moment, I think anyone that's interested, if you look at the Peterborough local area energy plan, it's a remarkable document that just gets really granular into how many heat pumps, how many EVs, how much industry is coming in an area, what's the geography of the area, how can we get it connected up together. We need to develop a net zero ready market. You know, we have, and this is something I think we need to be very thoughtful about it. We have all sorts of energy markets at the moment. We have a lot of network charges. We have a lot of grid services, and they all have built up organically, I suppose, over the last 40 years. But they're not suitable for a 2045 market. And when you look at the time frame for introducing a new market, it's maybe 2 or 3 years of academic research, 3 or 4 years of policy influencing negotiation, and then another 4 or 5 years of implementation. So you're probably 10 years away from having a proper market in place. And we're not seeing good quality debate. And what's going to happen if we don't just take a step back and say, what does a net zero market look like? We're just going to end up with tweaks and patches on existing market systems for another 10, 15 years. And they'll end up being overlaid and cut through by support systems, CFDs, government policy initiatives. And the market will sort of become a sideshow. It won't be relevant. And I think that'll give you a worse impact. I'll just finish up. I think there's been an awful lot of work in the last 20 years in supporting renewable energy, and there's been a lot learned from that. If policymakers are serious about decarbonizing heat and electricity, they should look at how were renewables supported, what went right, what was efficient, what went badly, and start looking at some of those examples, because I think the market system is as it is at the moment. It won't get the job done. If policymakers are serious about hitting net zero, it's going to need a more proactive set of financial instruments than what we have at the moment, with a hodgepodge of grants and off-peak tariffs and incentives, etc. And the last thing I'll say is, look, I would put out a call. The plans need to be realistic. It can't be planning to build, you know, transmission lines through forests and communities that are just realistically not going to get built in 20 years. They need to be net zero compatible. They need to actually say, what does a net zero energy system look like? And they have to be acceptable to society. If you're trying to build plans that are just socially unacceptable, it will end up with a backlash. And I think we'll have missed, as an industry, we are in a leadership position to help steer the world towards net zero and a better, you know, sustainable system that has higher quality of life. But if we try and do it in a way where we're pushing solutions down people's throats that they don't want or don't need, it's just going to set the whole thing back 20 years. And I think we have to be very conscious of that in everything we do. So thank you.
Thank you, Michael. You addressed a bunch of the questions I had in my head already, but I'm sure there's a ton more questions out there. We established the urgency around the issue, and we talked about the need to address it. Our next speaker's company, Lancium, is doing that through some controllable large loads in a lot of markets, but in particular, one of the largest markets in ERCOT. So we're going to hear about some of the solutions that are already out there. Andrew?
Okay. In particular, I'm going to be talking about where in America and the different kinds of market structures where loads can operate as a resource and where that really makes sense and how it kind of varies from market structure to market structure. And so a lot of what I'm going to go through has already been covered. We can get through this pretty quickly. We're building a lot of renewables. We are going to have 2 or 3 times as much load. We're at the same time retiring a lot of our old thermal generation. So that means a lot more renewable generation, and that renewable generation is intermittent and therefore needs more flexibility. As you can see here, we're getting a lot more negative pricing and things like that throughout the country as a result of all of that intermittency. Some of these renewables are caught behind transmission constraints, things like that. The generation isn't where the people are, isn't where the demand is. And to accommodate all of that, we're going to need a lot more flexibility in the system. And a lot of that flexibility is going to likely need to come from the demand side of the equation. And so what does it mean to be a load resource? And so I'm just keeping this really simple for the sake of this discussion. A load resource is any kind of load that can respond to a direct signal to reduce its demand. And that signal could either be something like a price, or it could be something like a physical signal, like the frequency on the grid has dropped and therefore the load needs to drop. More specifically, a controllable load is a load that can follow direct instructions from the grid on its output and provide ancillary services like regulation and all of the many named things that we've already been discussing all day. My company, Lancium, operates several controllable load resources in ERCOT. And so this is an example of one of our resources price response. So we submit a bid to buy curve based on the economics of that project. And then when the price gets above that break even, the project curtails its load. Similarly, we can provide frequency response. So when the grid frequency drops, our load drops correspondingly until the frequency is recovered. And right now we have a few hundred megawatts under control, but are in the process of building out a gigawatt-ish of load capacity. And so what I really want to talk about is what are the market designs and market structures that really incentivize this kind of development and operation. So you really have 3 types of businesses in the US, and the one, to not bury the lead, that seems the most amenable to building loads like this is when you have competition on both the retail and the wholesale side. So it's not just Texas, but any of the areas that are labeled 3 here on this chart. Those are going to have the most incentives for building loads that have these operational characteristics. You have your traditional vertically integrated markets. It's a lot harder to see where the benefit is to being a controllable load for a system like this. It's another customer for electricity, and so the operator likes selling electricity. Another kind of subtle benefit to it is it can better amortize some of the other assets in the system. So an example I like to use is electric vehicle charging. You build a multi-megawatt charging station, and it needs a substation or a transformer, and then its utilization factor is only 5 to 10% or something like that. So the cost recovery on infrastructure like that is really challenging. If you can pair that kind of infrastructure with a more flexible load that can adjust its consumption around when the charging station is being used, now the amortized dollar per megawatt hour for that kind of infrastructure is a lot better. And so that would be one example of how this kind of load resource can be useful even in a traditional vertically integrated market. You have another set of markets where the wholesale market at the end of the line is competitive, but the retail side of the equation is still very integrated. This would be your MISO and SPP. This is also just challenging because for a lot of these flexible loads, a lot of the benefit comes from the market exposure. We want to take advantage of the fact that a lot of the time the price of electricity is cheap, and will run during those times, but then we're going to turn off when the price of electricity is expensive. That leads us to an average price of electricity that's lower than the kind of fixed price we would get if we signed a fixed price contract with a regulated retail monopoly. And in a lot of these places, the ability to do that is just really limited. So if you look throughout MISO and SPP, if we look back at that chart of negative prices, a lot of those negative prices are in co-op territories, for example, where they really have limited incentives to offer a more market exposed pricing structure. They might not even have market exposure unless you get up to a very high level. So if you're in Iowa, for example, they're the distribution co-ops at the bottom, and they don't own any assets, and they're not really exposed to the market. They buy their power from a G&T, you know, they don't even necessarily have any exposure to the market. They're all essentially a subsidiary or buying their power from Mid-American, and you'd have to get all the way up to Mid-American or whomever at that point before you have any sort of market exposure. And so it's just really hard to incentivize this kind of controllable load, flexible load operation in a situation where you're going to get a fixed flat price pretty much by default. And then of course we have our competitive wholesale and retail, where you can get a rate plan that is exposed to the wholesale market, and you can participate in the whole suite of ancillary services. So on one hand, you're earning revenue providing ancillary services, and your cost of provision on the other end is minimized. And like I said, I didn't have too much to say today, so I kept it pretty short. That's the long and short of my talk. Market structure is really important if you want to think about how flexible loads could be a bigger part of the energy transition. And there's a lot of the country where a lot of changes are going to need to be made to the regulatory environment before any of this stuff happens. I know that there's a lot of interest in building, whether it's green hydrogen or green ammonia or other types of facilities in the middle of America where the LMP map looks really promising. But once you get to the retail level and see the kind of prices you can actually get, it looks a lot more difficult to figure out how those projects would pencil out. And that is all I have.
Thank you, Andrew. So to finish off our panel, we're going to talk to Agee from ERCOT. ERCOT has seen a lot of large load interest, as they have historically, but now we have hydrogen, we have battery factories, we have electrification of steel, we have a lot, and Agee is very busy with the large loads task force and trying to figure out how to integrate these large loads to keep ERCOT reliable.
Thanks, Allison. So yeah, we are, the finish line is in sight. My name is Agee Springer. I am the manager of large load integration at ERCOT. And I'm going to be talking about the challenges that some of the types of flexible loads that the other panelists have discussed present, both for grid planning and for just maintaining reliable operation. So when I talk about this topic, I like to show this slide. I'm going to go through it really quickly, but I think it's a good illustration of how things are changing on the ERCOT grid. We've had large loads on the system for kind of as long as ERCOT has been ERCOT. But in the last couple of years, we've started to see a new wave of large loads connecting to the system that are different in some key ways. First of all, many of them are bigger. So we're seeing interconnection requests, hundreds or even thousands of megawatts for a single site, which is a significant change. But these loads are also different in a couple of key ways. They often want to connect to the system much faster than industrial loads typically do. They want to connect often in 2 years or less. And some of them, not all, but certainly the wave of crypto mining that we've seen come to Texas wants to behave in a manner that is much more flexible and somewhat price sensitive, although I'd say there's a lot of nuance there, and I'll talk about that a bit more. And then as we look out into the future, we expect a large build out of hydrogen and electrofuel production that is probably going to kind of split the difference and be slower to interconnect, but more flexible in its operation. And so, if we look at where the system was with those purple dots and where the system's going in a couple of years, it's a real change in the nature of the large load connected to the system. So, we're really stepping into kind of a new world here. And so what makes planning for that new system challenging? There's sort of two things that make it difficult. The first is that the growth of this load is actually quite difficult to predict. There's a lot of volatility there. And the other is that the behavior of these loads is often not consistent and is, as a result, hard to predict as well. So planning becomes quite difficult. So I'm going to talk about both of these topics, for the rest of my talk here. So starting with the growth of these loads. So this is a slide that we show at our Large Flexible Load Task Force, which is a stakeholder body that's tasked with dealing with some of these challenges. And it shows just the growth of the loads that are wanting to connect to the system very quickly. So if we go back to that conceptual slide I showed a moment ago, it's all the stuff on the left half of that chart. Wanting to connect in 2 years or less. And so right there, you see the top level number is about 39 gigawatts is what we're tracking in our interconnection queue. To give you some sense of context there, ERCOT's peak load is about 85 gigawatts. So if all this were to be built, it would be quite an addition to the system. We don't expect it all to be built, but it gives you a sense of how much interest there is. I'm just going to highlight a couple of numbers here. The first is, how much has been approved to energize already. That's about 3 gigawatts. That's since 2022. So, for some context there, that's roughly the peak load of the city of Austin. So in about 18 months, we've added another city to the Texas grid in terms of size. So that's a pretty big change for 18 months. And then the rest of this chart shows, kind of projects that are in other stages of review. So from having their planning studies approved to under review to haven't even submitted studies for review yet. And I'll focus in now on just the projects that have had their planning studies reviewed, because this is an area that we've actually seen kind of balloon over the last 6 months. The amount of project megawatts that have ended up in this phase and then kind of stalled out has basically doubled in the last 6 months, from about 6 gigawatts to almost 12. And in that same time, only 500 megawatts has actually come to ERCOT and said, we're ready to energize, and requested approval. So this is sort of our first area of uncertainty with planning, is we're seeing more and more projects pile up here where they've gone through review of their interconnection studies and then all forward progress kind of stops. And so we don't know, as the grid operator, these are loads that allegedly want to come to the grid quite quickly. Is this 11.5 gigawatts going to be built? If so, when? We don't really have a good answer for that right now. So that's a real challenge and a lot of uncertainty. And even for the loads that have gotten approval to energize, there's uncertainty there as well, because we don't have a good view at the moment of how fast these loads are wanting to ramp up. It's really driven often by how fast they can procure the equipment. And, a large portion of this is crypto mining or data center. So it's very much driven by the machines that they're using and how fast they can install them. So even there, we've only seen a build out of about 2.5 gigawatts of that 3 gigawatt load, and we don't really have a good view of when the rest of it is coming. So that presents a real challenge for kind of long-term planning, especially as we have a lot of interest, but we don't know exactly if or when all of it is coming. So one of the ways that we're approaching this is we've proposed a revision to the ERCOT planning guide, which will put in place some formal rules around interconnections for large loads. It'll replace the interim process that we're operating under now. And among other things, it'll address some of these challenges by instituting some fees and some deadlines for the interconnection process that will hopefully help us push out some projects that are not moving forward. And also requiring these loads to submit a schedule for, really mapping out their ramp up, and an obligation to update it as things change, because the construction timelines are often quite fluid. So the growth of the load's hard to predict. These are, some of the ways that it impacts planning and how we're addressing it. I want to turn now to operational behavior for these loads, because that is also not easy to predict, and it presents quite a few challenges, both for long and short-term planning. So I mentioned a couple times that many of these large loads that have come in the last couple of years are crypto mining, they're data centers. They state that they're often very price responsive. And when system prices rise above a certain level, they want to cease consuming energy. And so we've done a lot of analysis based on that assumption. And what we're finding is that that's not always true. So just looking back at the past summer, which was quite hot, and we had quite a few tight operating days, we identified 8 where at least 300 megawatts of large load came back online late in the afternoon when the system was tight and reserves were declining, and system prices were above at least $250 per megawatt hour. Now, many of these large loads have, maybe slightly different strike prices where their economics kind of shift from being uneconomical to consume. But, conservatively, $250 a megawatt hour should be a point where none of these loads are wanting to consume. So, that's sort of was a disturbing kind of first look, as we're seeing loads at ramps of 300 to 600 megawatts when the system is tight and we weren't expecting it. That's problematic. We've also seen kind of the reverse, where prices have gone high above $500 per megawatt hour, and on 27 different days we identified at least 350 megawatts of large load that just didn't turn off even though the prices had spiked. So this is a lot of behavioral uncertainty that we're seeing, and we actually did a little bit of a deeper dive on this recently, and we said, okay, for the loads that we are confident are crypto mining, they've all stated that they want to consume energy, only when it's economical to do so. And so we did an analysis, and I've linked to it at the bottom of the slide. So, I invite you to look at it in much more detail than this one slide. But, how often are they actually curtailing when the price goes too high? And what we found is that there's really a range. Some of the loads, the ones on the right, do what we expect to. The price goes high, they curtail, above 90% of the time. So that's fairly easy to forecast. If we see that behavior consistently, we can kind of predict what's going to happen when we enter into tight conditions. But then you have all these other loads on the left here, and you can see there's huge spreads in behavior. And on average, these loads are only curtailing 40 to 60% of the time. And so that's a coin flip, essentially. Well, how do we plan for responsive load if we can't really predict when they're going to be responsive? And so that brings me to kind of the first of 2 challenges related to the operating behavior, is that we're seeing this inconsistent behavior that makes both long-term planning in terms of like resource adequacy. Do we model these loads as being curtailed during system scarcity, or are they still going to be on? And as well as short-term planning in terms of procurement of operating reserves, both of those are become quite difficult. And especially with reserves, we've kind of got stuck in a bind now, because if we plan for these large loads to self-curtail when we enter into high prices and scarcity, and then they don't, that potentially could drive us into emergency conditions. But if we procure additional reserves, assuming they're not going to turn off, and then we do, we've just unnecessarily raised the cost for consumers. So we're sort of in trouble which way we jump there. So there's a second challenge that has to do with this flexible behavior, though, and that has to do with the rate at which these loads who consume drop off the grid, because that actually does matter, especially for short-term planning in terms of frequency regulation. So, just a very quick bit of background. Andrew already helped me out a little bit here. So we dispatch our generation every 5 minutes via SCED. And in between those 5-minute intervals, we have regulation service, which is megawatts that are reserved to balance generation and load, just due to the natural sort of short-term variation of load, within the 5-minute interval. And so any variation in load between SCED runs has to be covered with regulation to keep the system in balance. Well, what we're seeing now is, we have all these loads that are capable of ramping their full consumption within a 5-minute sched interval, and some can do it as fast as, like 90 seconds. So, some of these loads are capable of coming on or off the system pretty quickly, and they all have roughly the same kind of pricing behavior in terms of what triggers their response. And so as a result, we're now seeing ramps where in aggregate, these large loads can actually ramp enough to exceed the available frequency regulation, how much we've actually procured for the interval. And the reason this happens is because most of these loads are, in fact, the overwhelming majority are operating outside of the economic dispatch. So they're not participating in sched, and that means that sched's not accounting for that ramping behavior because there's no way to predict it, and doesn't factor that in when it dispatches generation. So when the ramp does occur, it has to be covered by frequency regulation. And so we've started to see a kind of noticeable increase in the number of intervals where the large load ramping behavior has exceeded the procured regulation. And to be clear, I'm not saying that in all these intervals regulation was exhausted, because there are other factors, such as wind and solar ramps, other load ramping behavior that might determine how much regulation is actually deployed. But what is concerning here is that we're stepping into a world where the large flexible load ramping by itself is enough to potentially exhaust the regulation and limit our ability to control frequency. So we saw a market increase in the summer, and that's concerning as well. Now, what do we do about some of these challenges? Well, it's been suggested that ERCOT simply procure more frequency regulation. I mean, if we're running out of it, let's get some more. That has some, it's a possible path forward, especially maybe in the near term, but it has some downsides. So regulation megawatts are reserved out of the dispatchable generation pool simply to control frequency. So if we buy more regulation, we're actually taking those megawatts out of the dispatchable pool during scarcity conditions. And, we're again talking about ramps of hundreds of megawatts. So if we have to start reserving hundreds of megawatts more regulation to cover that type of behavior, that raises the risk that we go into emergency on tight operating days. It's also a paid service. ERCOT has to buy this service on behalf of consumers, so it's raising costs to have to buy more of it. And finally, in the same analysis I mentioned earlier that was linked to earlier in the slide deck, we also explored what would happen if that 11.7 gigawatts of other large load that has had its planning studies approved, what happens if that connects to the system? And what we found is that the amount of regulation that might have to be procured during some of these operating hours may just become infeasible. It may just not be realistic to buy enough regulation to cover this ramping behavior without other changes. So, to kind of echo on the theme of some of my other panelists, some of the existing structures and ways of doing things, we may be approaching a point where those start to break down. And so, from our perspective, coordination is sort of the key to managing these challenges. So, we think the best solution is for as many of these loads as possible to become controllable load resources if they're going to engage in this type of behavior. These loads are still free to set their own strike prices via a bid to buy curve. Andrew talked a little bit about that. But the ramping behavior becomes incorporated into the economic dispatch, and as a result, it becomes coordinated with the other reliability needs of the system. And so you're no longer having to use your frequency regulation to cover ramping behavior that is driven by just a desire not to consume at high prices. So we think that's a good path forward. And then, potentially, depending on how many loads we kind of see move into that bucket of controllable loads, we may also have to limit the ramping behavior of loads that elect not to do that, because again, it presents a growing risk to frequency control. So just to kind of bring it all back together, I talked at the top, this is really a period of significant change in the types of load we're seeing connect to the grid, and also the ways in which they operate. And because they're so large, they have the potential to impact grid reliability in a way that really we didn't even, sort of envision even a few years ago. And they impact both operational reliability, but also long and short-term planning. And so, I mentioned a couple times the revision requests we've proposed to the ERCOT protocols, and those are sort of our current best thinking of, some of the ways to deal with these challenges. So with that, I will end and pause for questions.